Hey guys, today we're going to be talking about the balance of payments. So think of this as like a spreadsheet of how a way we record our financial transactions with other countries. So just like a record book or like a spreadsheet of where we just like, okay, here's money leaving, money coming in, and there's words for these words. There's words for these terms. So if you see over to this way over here, it says money coming into a country is called either a credit or an inflow. So, unfortunately, I'm going to say some words that might be different than how I've used them in the past. So, in this unit, it's more of accounting and less economics. And so, I'm going to use words like capital, when usually in economics that means like pizza ovens and factory machines and things like that. But when we're talking about currency in this class right now, we're talking about capital being money, which is how accountants would view capital. They say it money. So if you see if money's coming into our country, it is inflow of capital or a credit. If money's leaving our country, it's either called a debit or an outflow of capital. It's money leaving, it's flowing out of our country. So the balance of payments is a record of transactions between countries, and there's different accounts. There's different, it's called accounts, but just think of it like there's different pages of the spreadsheet. Certain transactions go in one account, other transactions would go in another account. So the first account that we're going to talk about is called the current account. And there's several things in the current account, different transactions. The first transaction you guys know of is trade. Net exports, basically exports minus imports. So our trade balance, whether we have a trade surplus or a trade deficit, is going to be recorded in the current account of the balance of payments. Another different type of transaction in the current account is something called a unilateral transfer. It's a one-way transfer of money. With trade, it's money being exchanged for goods and services, but a unilateral transfer, it's not being exchanged for anything. So maybe immigrants send a portion of their paycheck to their family that lives in a different country. So that would be money flowing out. It's an outflow, and it's an inflow into that foreign country. So they're not buying anything from their relatives, they're just sending money home. The United States also does this when maybe developing countries might have like a natural disaster, like an earthquake or a flood. We might just send financial aid. We're not buying anything from this country, we're just sending them money. So that would be an outflow from our country and an inflow of money into their country, into their unilateral transfers section of the current account of the balance payments. And the last thing in the current account is net foreign income. What that basically means is any money made from foreign financial investments. So we're actually talking about financial investments being like stocks and bonds. So if I just said the word investment, that means business spending, or like investments is business spending. But financial investment, that's going to be stocks, bonds, savings accounts, things like that, away like, your retirement savings, things like that. So if you make any money from a foreign, it has to be foreign because otherwise it wouldn't be in the balance of payments, because in the balance payments is between countries. So not money that you make in your savings account, but maybe you have a savings account in France or in like Switzerland, or maybe you have bonds in a different country, or you have stock, like foreign stock. So maybe you wanted to buy Honda stock. Well, any money made, maybe any interest, any dividends that you get on stock, any profit earned on financial investments abroad are going to be in the current account. So once again, it's trade, unilateral transfers, and then money made on financial assets in a different country. The financial assets themselves, like the bond, the stock, the savings account, well, that's going to be in the next account for the balance payments. It's called the financial account. And so, of course, we're going to have financial transactions in the financial account. It used to be called the capital account. So if you see an older worksheet or an older Quizlet term or something. They might call it the capital account. It's now called the financial account. But here are a couple things in the financial account. First thing is direct foreign investment. So this is basically real estate. If you buy real estate in a different country, the purchase of that land is going to be in the financial account. So let's say you wanted to buy like a theme park. When Disney World decided to create a Disney World in Tokyo, and there's one in Paris. Well, that purchase of land for Disney would be that would be in the financial account of both our balance of payments and like Tokyo's balance of payments. So it would be money leaving from our financial account and money going into the Tokyo and into the Paris financial account, because it's money, it's land. And so it's going to be both in our financial accounts, just one of our country will have an inflow while the other country has an outflow. And the other thing, like I said earlier, is foreign financial assets. So if you see stocks, bonds, savings accounts are going to be in here. So that's tricky. The stock itself is in the financial account, but profit, money made, interest accumulated from those investments is going to be in the current account. So let's say that you buy a bond for $100 and it has 10% interest. So the $100 bond is going to be in the foreign financial asset. It's going to be in the financial account, but that $10 of interest, well, that's going to be in the current account. So the investment itself is in the financial account, but any profit made on top of that is going to be in the current account. So this is called the balance payments because these two should balance itself out. Meaning if there's a deficit in one, there should be a surplus in the other by the same amount. So if the current account is, let's say, negative $10 billion, the financial account should be, in a perfect world, positive $10 billion because they balance each other out. If there's an inflow in one, there's going to be an outflow in the other. If they don't, because life is not perfect and life is messy, then this third account is the balancing agent. It's the official reserves, which just basically means it's a bank account in the Federal Reserve that just holds foreign currency. It holds euros and yen and pesos, and it balances the other two out. If we have a deficit, like an overall deficit between like us and Mexico, then maybe this would just be some pesos, just a surplus of pesos to balance the other two out. If we have a surplus, let's say the current account's in surplus and the financial account's also in surplus, it shouldn't be, but let's just say with, let's say, Spain, then we're going to have all that surplus money just dumped into the official reserves. So they balance out and they should all equal zero. So the current account plus the financial account plus the official reserves will be zero. They balance each other out. Surplus in one, deficit in the other. If that doesn't work out perfectly, the official reserves is the balancing agent. So that's it for the balance of payments. Today you're going to do a little practice sheet where you have to determine, is this a credit or a debit for the United States? You have to look and see that this is for the United States in all scenarios. So of course it's going to be a credit and debit somewhere, because if it's a credit in one country, it's a debit in the other, but you're looking from the point of view of the United States. Is it a credit or a debit? Money coming in, money leaving. And then this is an older worksheet, so it still says capital account, but you could cross that off and write financial account because that's the new name of it now. But then you have to determine, is that a current account or is that a financial account transaction for the United States? So you're going to put a check in one of these boxes for inflow or outflow, credit or debit, and then another check for which account it would be. And then on the back, you're going to be doing some practicing balancing two account outs and answering some questions based on the math that you did up there. So if you have any questions, ask, leave a message, and we'll be going over this in our next Google Meet. But other than that, have a great day. That's the balance payments. Not too bad. You just gotta, which account goes where, and that is it for today. All right, bye guys.